Good morning, ladies and gentlemen. Has been a very tumultuous week, probably one of the most important ones that we are going to see for many, many years. Well, Donald Trump is now president, and it behoves us to have a look at the longer term trend in the market that is going to determine all other asset values, and that is the bond market. Let us step right back and have a look at a monthly chart of the 5-year yields. This is where we are. We have had a very nice spike up to about 150 in yield. This is a monthly chart once again, and we can see we're just showing you this for perspective, for the sake of perspective, to see where we are in a 50-year time frame, and where we could go back to if Mr. Trump really means what he says. His policy now is one of not relying on monetary policy anymore, but relying on fiscal policy to boost infrastructure and all other government spending to basically get the economy going again. Whether he will be successful, we have no idea, and nor does anyone else. What we do know is what happens to rates when fiscal policy gets loosened and monetary policy tightens at the same time, which is what the Fed is threatening to do over the course of the next few weeks. We don't think that this position is sustainable in the long term, but in the short term we are bound to get huge spikes in yield, we think. Let's move on to a weekly chart of the 5-year note, and then we'll look at the 10-year note as well. We can see that the key level on both monthlies and weeklies is around 185 in yield. We think that we get there possibly before year end. It is such a big change in policy that we do not see how the market can possibly sustain these levels here. We think that we keep on going until at least 185 in yield on the weeklies. If we now change to the 10-year note, this is again a monthly on the 10-year note, just to show you what the very long-term perspective is. This is the last 50 years of yields. We see that very much the same picture is evident on the 10-year note. We have broken a trend line which has been in place since the 07 debacle, and what the market is telling us here is that we are potentially seeing the beginning of reflation and the end of deflation. What is the huge level that we probably have to break? Around the 235 area, we would argue. Will we see it? Yes, we think we see it very, very quickly. We closed the week around 217, 235 is only 20 basis points. We moved just about 30 basis points last week. Another 20 basis points is really not that much to ask for. We might have a couple of weeks of consolidation, but the break of this trend line and the break of all these very important yield levels around 190 to us indicates that the market believes what Trump is saying, and that it will trade, if not spike, the 235 area. If we are to take Mr. Trump at his word, and his advisors like Carl Icahn, and there is no reason at the moment to fight this trend, we have to believe that long-term funding for infrastructure projects, demand for it is going to go through the roof. 30-year notes, this is a chart of 30-year yields. Well, we are, this is a weekly chart, we are almost bound to go and test the 340 yield level. We were here back in 09, we were here back in 12, we were here back in 14. We certainly think that by the end of 16 or the beginning of 17 we can see 340 yield on the 30-year, which is still another 50 basis points from where we are at the moment. This is what tight monetary policy and loose fiscal policy does to the bond markets. It is the most bearish of all possible outcomes for the bond market. It is not a surprise that the bond market reacted the way it did. It is not a surprise if the bond market just keeps on going. Maybe it does small retracements, 2, 3, 4, 5 points, and then goes again. Bond markets are going to anticipate a huge flood of issuance and a huge reflation trade in the US. Will the European markets be immune to such a change in US policy? And our answer is absolutely not. If people find it expensive to borrow in dollars, they will borrow in euros and just take the FX component out of it. This is a weekly chart of yields in Germany. You can see this very important trend line which has caught the market for the past 8 years. This is the big downtrend from the 2007 debacle that we had in the markets. It is now being tested, and more importantly, we have a level of 43 basis points, which is just behind it. We think the market eventually, over the course of the next few weeks, breaks all those levels and we go and trade possibly very close to 1%. These are huge moves in the bonds. We have to be short of all bond markets at all times. Will there be bounces in price? Of course there will be, but we think that the big trend has now established itself, and it will go a lot further than anybody can imagine at the moment, simply because the demand for funding, if people perceive that rates have bottomed worldwide, they will want to have to issue as much as possible and for the long term, and that will change the whole balance between supply and demand. People aren't going to care whether they issue at 25 basis points or 35 basis points. They will just want to have the money on board for the long term. And therefore that actually steepens the yield curve and actually could make yields go much higher than they are at the moment in all markets, in all developed markets, dollar markets, euro markets, Swiss market, you name it. People will want to issue wherever they can, wherever is cheapest, and they will not care about the FX risk, certainly not for the first few months. So our advice is absolutely to get short of bunds, get short of BTPs, get short of treasury notes, get short of long-term bonds on any pullback, and just keep on adding to your position until you see signs of exhaustion, which is going to take many months before it happens. If we are right about the direction of rates in the States and worldwide, what effect is that going to have on other asset markets? Well, the most obvious effect is going to be that equities are going to outperform bonds, which will not be hard to do because bond markets will be losing ground hand over fist. Quite obviously, the biggest beneficiary should be the Russell 2000 and the small companies which produce shale oil, which produce pipes for pipelines, which are also the regional lenders that will lend money to the companies producing these goods. And the market has quite correctly jumped in the Russell 2000 to near record levels. If we turn this into a weekly chart, we see that we have basically returned to the levels that we were in 1915, I mean in last year 2015, but that actually we have done almost nothing since the 2013 spikes. This probably means that this market has quite a bit further to go after pulling back after such a huge rally this week. But at no stage would we think of shorting the Russell 2000, and we would only be looking to add to our long positions in Russell 2000. All the other markets will be dragged up with it. It is nonsensical to say that a market like the ES will not rally with it. It will just rally less. We would not be surprised to see now a real squeeze in the Russell 2000 into year end, with possibly another 5 to 10% appreciation. We certainly would not be surprised to see the ES finally break the 2200 level and possibly trade slightly higher. But that is a market which is going to have a lot of difficulty with the stronger dollar, and we just don't think it is as obvious a buy as certain sectors are. Financials, and finally still we cannot get bearish of the XLK, regardless of the charts, simply because we don't see that anybody can possibly take the place of the United States in the high-tech markets. Therefore, XLK is a core long of ours, regardless of technical position over the next few weeks or months. The most interesting and volatile asset class over the next 3 or 4 years is actually going to be the dollar. The dollar is going to obviously love for a period the higher rates, higher relative rates in the States, which will be achieved through fiscal expansion. Fiscal expansion and monetary contraction are probably the most bullish combinations that the US dollar can achieve. Therefore, it is not surprising that, contrary to what we thought originally, that the US dollar has responded the way it has. It always has a time lag, which we didn't take into consideration. We thought the market would try to give Mr. Trump what he wants, but actually the market is being swamped by demand for dollars. Everybody who is short dollars is covering and is and the longs are actually adding to their positions, which in the short term makes sense. We now believe that the dollar will easily break the 100 barrier at some stage over the course of the next couple of months, possibly go even to 105, even to 110. What does this period remind us of? This period very much reminds us of the beginning of the 1980s. This is a chart of the Deutschmark trading against the dollar. We had a very similar period right here in about 84, when the dollar, contrary to all logic, because the United States wanted jobs at home, spiked a good 10% before absolutely collapsing. And we think that we are in that kind of period. We are somewhere around here. We will see now a period of dollar strength, taking it up a good 5 to 7% before we have a total collapse in the dollar. Why? Because it's obvious that the only way the United States can sustain any kind of fiscal injection is by having manufacturing return home for the long term. If you just build one pipeline, or you build one oil field, or you build one airport, or you build one road, that is a one-time event. People get paid, they go home, they spend their money, end of story. To have sustained employment, you need to have regular work for the long term. With the dollar where it is, nobody is going to open factories in Michigan and Iowa for the long term. And I am sure that Mr. Trump's economic advisors are perfectly well aware of that. The US has basically bailed out the rest of the world for the past 4 or 5 years by accepting a higher level of the dollar. Donald Trump has referred to this repeatedly, and we think that at some stage over the course of his first term, they will try to engineer a much lower dollar policy to get the jobs coming back to the US. How they're going to do that, at the moment we have no idea, but the thing that makes the most sense is that Donald Trump does what he has always done, i.e. he will leverage the country to the hilt, issue as much as he can, and then try to repay with devalued paper. That means that he will try to monetize the debt, and if that happens, this is what you will see. You will see a total collapse of the dollar to levels last seen in, let's call it 1908 to 2008, 2012, where the DX was trading roughly at 75 to 80. Here are those levels, 75 to 80. We will now possibly see a huge spike up to 105, 110, which will be completely and utterly unsustainable before a very, very large move down, back at least to where the move started, which is just below 80. That is what we think is the very big picture. It is going to be very, very volatile because these moves are of historic proportions. Therefore, we are actually, for the first time in many, many years, not sellers of volatility anymore. We think that the trend in volatility could actually change. Our spikes up could be very much more sustained. We're not just talking about equity volatility. Equity volatility we're probably the least worried about. We are worried about volatility in the dollar, and we're worried about volatility in precious metals, and we are worried about especially volatility in bonds. But volatility in bonds and dollars will engineer a higher volatility long term in the equities as well. Probably the least volatile will be equities, but bonds and the dollar, in no way are we sellers of options. From now on, we will be only buyers of options in those markets. So as for the biases for next week, from now on, we are sellers of every 100-point bounce in Bunds and BTPs. Every time that the ES falls back because of high yields or whatever panic there is, we will be buyers of the 2070, 2085 area. We will prefer the Russell 2000 as our long instrument. So when we feel that the market is ready to bounce, we will be preferred buyers of Russell 2000. TLT, 10 years, 30 years, all bond ETFs, we will short every squeeze. 127.50 is a very important level in TLT, as close as possible to that, with a stop above 127.50. And in the US dollar, we will play what the market gives us. We will buy dips and sell spikes, but we are pretty sure that the market will continue upwards and break the 100 level. But it is an unsustainable level, and longer term we are quite sure that we will return to the levels last seen in 2012, around the 80 level. So the market will give us a very nice setup for a longer term sell around the 105, 110 area. We are quite sure of that, but that is very much longer term and not something that we have to worry about at the moment. Looking at the Blue Angels, you can see how the 16 times Blue Angel caught it wonderfully. Do we have room to rally to the 17-time Blue Angel before year end? Absolutely, just above 2200. So 2200, 2220 will be the upside for the S&P, but that will probably be nothing compared to the upside that you will get in the Russell 2000. If the S&P now rallies another 3%, the Russell 2000 could easily treble that and rally another 10%. So Russell 2000 is a much better buy. In terms of sectors, XLF is still our preferred long. With any dips in XLK, we want to buy for the very, very long term. Thank you very much. We really think that this has been a historic week, and that all the trends that have developed during it will continue much further than you can envisage at the moment. Bonds could get absolutely destroyed. Why play all the other harder markets like equities or the dollar or precious metal when you can actually play the one that, in our opinion, is going to be the real risk reward? Buy, basically put options on any rally in 10-year notes, 30-year bonds, 5-year notes, bunds, BTP. Any rally in those, and there will be rallies, is a buy of puts, put spreads, anything that you can get your hands on, because both volatility and price, volatility will go up and price will go down. Thank you very much indeed, and we will tweet anything that we do very early next week. Have a lovely weekend. Bye bye.